Nvidia invests $5 billion in Intel, launches strategic chip partnership. On September 18, 2025, Nvidia announced a major investment in longtime rival Intel, signaling a dramatic shift in the semiconductor landscape. The deal is both a financial lifeline for Intel and an effort by both firms to accelerate innovation in AI, data centers, and PCs. Key terms of the deal: $5 billion investment. Nvidia is buying Intel common stock at $23.28 per share in a transaction subject to customary regulatory approvals. Shareholding and valuation. The investment gives Nvidia approximately a 4% stake in Intel once the share issuance is completed. Intel stock jumped percent on the announcement. Partnership focus. Intel will develop custom x86 CPUs tailored to interface with Nvidia's AI infrastructure, particularly for data centers. For PCs, the companies will collaborate on system-on-chips, (CS), that combine Intel's CPU capabilities with Nvidia RTX GPU chiplets. Context and Intel's situation. Intel has been under pressure in recent years. Financial losses have mounted. Last year, Intel recorded a large annual loss, followed by further losses in the first half of 2025. There have been layoffs and a reorganization of its workforce. Intel has faced competitive challenges in both CPUs, from AMD, and GPUs accelerated computing, from Nvidia and others. Also worth noting, this deal comes close on the heels of the U.S. government acquiring a 10% stake in Intel, part of a broader effort to shore up domestic semiconductor capabilities. What Nvidia gains: access to Intel's strong x86 CPU ecosystem and manufacturing infrastructure, which helps Nvidia better integrate its AI platforms with more traditional CPU architectures. Potential for deeper influence or integration in the PC and data center markets, combining GPU and AI strengths with Intel's reach in general-purpose computing. Risks and uncertainties. Intel's foundry business remains weak and has not seen strong demand. It's unclear how much of the manufacturing burden Nvidia will shift to Intel versus continuing with external foundry partners like TSMC. Regulatory hurdles could emerge given the size of the investment and potential antitrust implications in strategic technology sectors. Execution risk. Integrating CPU and GPU design, ensuring production quality, aligning roadmaps, meeting performance and cost expectations are all non-trivial. Strategic implications. For Intel, this partnership may mark a turning point. It not only brings needed capital, but also helps restore relevance in the AI era. Intel may be repositioning itself more firmly in the AI supply chain rather than just competing on CPUs alone. For the U.S. tech ecosystem, the deal is seen as bullish, reinforcing efforts to strengthen domestic chip manufacturing, reduce reliance on foreign foundries, and maintain competitiveness in AI hardware. For competitors, AMD and other CPU/GPU makers are likely to see this alliance as a threat, especially as PC and data center customers increasingly demand tightly integrated AI-capable hardware. What to watch? Whether Intel can deliver on the timeline and performance of the new chips designed jointly with Nvidia. How much of Nvidia's workloads will shift toward Intel's manufacturing versus maintaining existing foundry partnerships. The regulatory response, both in the U.S. and globally. Impact on the competitive floor. Do AMD, TSMC, etc. change their strategies in response? Conclusion. The Nvidia-Intel deal is more than just a financial transaction. It's a strategic realignment in the semiconductor world prompted by the rise of AI, increasing demand for integrated CPU/GPU systems, and geopolitical pressure to localize technology production. If executed well, this collaboration could reshape the competitive balance in computing, especially in AI-powered infrastructure and PCs. But there are many moving parts, and success is far from guaranteed.